Ever wonder how a moving average could adapt itself to volatility instead of lagging behind it? This breakdown covers the McGinley Dynamic Fusion, a dual timeframe adaptive smoothing system built for identifying shifts in trend equilibrium. At its core, this tool replaces the standard moving average with the McGinley Dynamic, a self-adjusting formula that automatically speeds up in fast markets and slows down in choppy ones. Unlike a fixed-length moving average, the McGinley Dynamic uses a recursive adjustment factor, dividing the price deviation by a function of the price-to-previous value ratio raised to the fourth power. This creates a smoothing line that tracks price more efficiently, minimizing the whipsaw effect common in traditional moving average crossovers. The framework runs two of these McGinley dynamic lines in parallel, a fast-reacting line and a slow-reacting line, and analyzes the relationship between them. A crossover condition is identified when the fast line transitions from below to above the slow line, or vice versa, signaling a potential shift in short-term momentum relative to the longer-term baseline. To add confluence, the system incorporates an optional higher timeframe filter using request.security to pull data from a broader timeframe and confirm that the crossover aligns with the dominant directional bias on that higher timeframe before it's considered structurally valid. Beyond signal generation, the indicator applies a volatility-based risk framework using the average true range, ATR. Once a crossover condition is confirmed, the system calculates a series of reference levels, projecting a stop-loss distance and 3 sequential target distances, all scaled by the ATR reading at that moment. This ensures the framework adapts its reference levels to current market conditions rather than relying on fixed pip or point values, which is a foundational concept in volatility-adjusted position analysis. The visual layer includes a heat map candle system that recolors price bars based on the directional bias between the two McGinley lines, offering an at-a-glance read of trend structure. A built-in dashboard further quantifies this relationship, displaying the percentage gap between the fast and slow lines along with a calculated reward-to-risk ratio for the first reference target, translating raw calculation into a visual, easy-to-interpret format. The system also includes a cooldown mechanism, requiring a minimum number of bars between signals to reduce noise from rapid, sequential crossovers in ranging conditions. Finally, the script includes a webhook alert payload system, structuring JSON-formatted data for entry, stop, and target levels, allowing the framework to communicate with external automation tools for those studying algorithmic execution concepts. By the end of this walkthrough, here's what you'll take away. How the McGinley dynamic formula differs mathematically from a standard moving average and why that matters for lag reduction. The mechanics of a dual-line crossover system and how directional bias is derived from the relationship between two smoothing lines. How higher timeframe confluence filtering works using request.security to align short-term signals with broader market structure. The principles behind ATR-based volatility scaling for constructing adaptive reference levels instead of fixed distance levels. How a cooldown mechanism helps filter signal frequency during periods of low directional conviction. The structure and purpose of webhook alert payloads for connecting analytical tools to external automation systems. Warning: educational software for analytical purposes only. Trading involves significant risk.